Hey everybody, this is David Skarica. So this is a special members edition. This is going to be coming out on Thursday. Because it is early, I may not do one on the weekend, or I might just wait till Monday or Tuesday. Because we're putting this out on Thursday, rather than putting on, we already did one on Tuesday. I'm doing another one on Thursday, but I am definitely going to do one between Saturday, Sunday, and Monday or Tuesday, because I got a unique kind of beaten up sector I want to talk about. So we'll do that. But for today, we're going to, I talked about the Fed. You saw my free stock chart of the day if you saw that. So today we're going to really look at, look at this here. We're going to look at the Fed and what happened. So let's go back. I talked about it quickly in stock chart of the day. So look at the free one. So we'll just quickly talk about it. Like the Fed was pretty dovish. We're now looking at, a nearly 80% chance of a rate cut in March, and then a nearly 80% chance of another rate cut in May, and then nearly 76% of another rate cut in June, and then a nearly 67% rate cut chance of another rate cut. So that's 4. Really, they're pricing in 5. I don't know. I was looking at 75 to 100 basis points would be 4 quarters. The market's looking at 5 quarters. These things can change, but yeah, I think now it's obvious that we definitely have gone from, the tightening cycle to the non-tightening cycle. And to me, it looks like a typical loosening cycle for the Fed, where like, I've showed these in the past. Actually, you know what? Let's quickly look at those, because I didn't really look at those in detail. So let's do that for the members here. Let's go look at we're going to get an S&P chart that goes back to like 1980. So it looks like a loosening cycle that is like typical of, that's just a spider, sorry, SPX. So there we go. And you can see the loosening cycle. Let's go, first we'll look at the mid 80s, and boom, when they started to cut rates, huge move, S&P about 100 to nearly 170 in just a year, right? And then they raised rates a few times in 84, and then again, boom, 85, 80, late 84, 85, 86, when they started cutting rates. Another huge boom into 86, the S&P going from 150 to 250. So huge moves, 50%, 70 and 50% moves. So it does look like, and if we go like, I'll show you the TNX. And you can see the TNX, that rate cut cycle. And then you can see the 83, 84 rate hike cycle. And then again, the 85. So this looks typical, where you get the tightening cycle, equities go down a bit like they did in 84, like they did in the early 80s during this tightening cycle, and then when they loosen, stocks go up. So then we're going to go look at, let's go look at the early 90s. So then, or the early to mid 90s. So then you can see the Fed began, they cut rates a few times after the Persian Gulf War, and stocks did very well. The S&P went from just over 300 to over 450, another 50% roughly move in a few years as they cut rates. They raised rates in 94. There was a correction. It didn't lead to larger stock prices. And then in 95, they began to cut rates and did nothing in 96. And you can see this huge run of 450 to nearly 830 on almost 100% run in 2 years in equity. So again, a typical rate cut cycle. And we go again, look at the TNX. We can see here, again, look at that 90s kind of rate cuts, and then look at the hikes in 94, and then the cuts in 95. This is the kind of rate cut cycle I'm looking for. I'm not looking for rates to, plummet back to zero. I'm looking for rates to kind of like take back some of this prior rate hike cycle. And obviously rates were coming from 5% in 93, and they went to 8. So this is the 10-year treasury. Actually, let's get the short bond so we can see that, rates on the short end went from 3 to 6. Well, this time we went from 0 to 5, and then they went back to about, 4 3/4. So yeah, maybe this time we go like, this time we went from 0 to just over 5. We go back to 4, something in that round. So I'm looking for something kind of similar, but it looks like if you go look at like the time frames, we'll look at 98 too as well now. So you know what? I'm going to make this for everyone, because this is some important information. So, you know what? Maybe I'll make the one I did today, part 1, and then this one part 2, and I'll still do a members version. Okay, so this is this is the S&P again in the late 90s, and you can see, there was one small rate hike, I think a quarter of a point, 97, but really nothing major. And it just shows you at times in flattened interest rates, which I'll show you in a second, equities can do well, then everything tanked. Now look at when these things tank, and then they cut here in 98. Now, some people, when we'll look at the 2000s and we'll look at 2007 in a second, we'll look at the time frames when they cut rates and stocks went down. But the difference was stocks were already going down into the rate hikes. And I think that's, or rate cuts, there are already warning signs for the economy, for the market. But I think when you don't have these massive warning signs and they loosen policy, it's a sign that stock prices are going to go higher. And here you can see, in 90, we were flat and stocks rocketed in 96, 97, 98. They cut during the Russian crisis. Well, some of this IRX was as a price to safety. The Fed funds did not go that low. That's why it came right back. But they cut from 5 to about 4 and a quarter, as you can see. And then in 99, they began taking these back. And then, stock prices were already going down in 2000 when they cut. I think that's the difference between them cutting in 2001 and them cutting now. Stock prices have been moving higher for over a year, where stock prices in 2000, 2001 were going low for a year. And we'll look at this. It's the S&P here. And you can see the S&P had already been rolling over in the early 2000s. The S&P, before they cut rates, had been going from over 1,500 to about 1,300 and continued to move lower, right? So the trend was already down. The tech bubble was bursting. And the same goes for the 2007, 2008 period. If we go look at that, what we can see is, and again, look at this, when they stopped raising rates in 2005 to 2006, look what stocks did when they stopped raising. So sometimes stop raising, because usually when they stop raising and don't cut, it means the economy is pretty good. So if they do not cut as much as people think, that actually could be better for the stock market next year, because it'll be a sign that we're not in a recession and they don't have to cut rates, right? So again, if we look at the S&P here, we can see this, what it did. But in 07, 08, it's the same thing. When they cut, right, you had this big bust here in the summer of 07, that's when they cut. And there was already signs, like if you go look at, for example, like the housing sector. Sorry. JUSHB. You can see the housing sector here, and it was already rolling over, obviously, and had been for a number of years before that. And even after the rate cuts, that housing stocks were more than 50% off their highs. We go look at the banks, it was the same thing. Even at these cuts, banks continued to drop lower. So those were warning signs. We're not seeing those kind of warning signs. We're seeing, markets kind of rallying here into this. So it looks more like, when they cut rates to 0 in 08 and 09 and they started QE, look at when they started QE about here in the spring of 09, stocks again were that's the housing stocks, but stocks were starting to come off their lows when rates went back to 0. So then let's go look at another rate cut hike cycle. Let's go to 2018. So it's the same kind of thing. In 2018, they I'm going to end this in the end of December of 2018. The Fed raised rates and the market was moving lower. And then they basically signaled that the rate hikes were going to end. So we'll look at the short-term rates and we can see that rates, moved higher all through 2017 and 2018. And then at some point, stocks kind of really started to roll over. And you can see that the short-term rates went to over 2% at the time from, basically 0 in late 2016. So, but then they signaled they were going to stop the rate hikes. And you can see the first half of 2019, rates were flat. Well, stocks, just because they had stopped the rate hikes and were signaling they were going to cut, stocks in 2019 had already soared into the rate cuts. So I think that's kind of what we're seeing here. And you can see what happened is stocks kind of after this big steep correction, similar to kind of what we had in 2022, kind of went straight up, went to these new highs, had a couple small corrections at the highs, and then continued to move higher. That's kind of what I think may happen here, that we are overbought short term. I'll talk about that in the stock chart of the day next week. But yeah, we're kind of overbought short term, and then essentially we may continue to move higher. After we kind of maybe get a couple little corrections in here. But again, what happened again? They stopped raising rates, stocks rallied into that, and then we're already getting near new all-time highs just on the premise of that rate hikes were over. And then when they cut rates, everything went higher. So I think that's again the kind of scenario that we're into now. So that's just kind of what I want to show you here. And of course, in 2020, everything crashed during COVID, and then they, cut rates to zero, and then everything started moving higher. So like when Martin Zweig said, "Don't fight the Fed," he also said, "Don't fight the tape." So that's kind of what I'm seeing now. We get into, what's going on at the moment is, at the moment in stocks is basically, we're going back to 2021 here, is that we're seeing the market kind of gap higher, and it's like we're very overbought. You can see the RSI where it is. So like we could see one of these little corrections here, especially the S&P could obviously have resistance at its all-time highs. But when I see the tape action right now doing what it's doing, it tells me that it looks more like a 95 scenario, a 98 scenario, a 2019 scenario, where the market is rallying into some of these things. And one thing I've talked about, if you look at the, I talked about yesterday, was utilities, natural resources, precious metal equities, some of these beaten up turnaround plays that we own. These are the things that are probably going to start outperforming the Magnificent Seven stocks, right? Here. So again, I just wanted to show you this. Now, could the Fed start to cut rates? Now, if something like the economy totally falls off a cliff, in the first half of 2024, maybe they will go down, right? Maybe equities will severely go down. And like I said, we're so overbought here. You can see the RSI when it got here and here. This was a good 3-month, 10% correction. So yeah, I wouldn't be chasing anything at these levels, but I would definitely say the chances are leaning more on the side that the Fed will cut rates next year, and probably equity prices will move higher after some sort of correction here. So for my again, for the premium members, I'm going to continue this video talking about a couple of our positions, et cetera, going forward. So I hope you enjoyed this. I hope it was like informational. And like I said, again, that's where you're mixing the action on the tape with the action of what the Fed is doing. So like I said, in 2007 and 2000, 2001, the market was moving lower into the Fed rate hikes, and you could see this bubble was kind of bursting, right? And in 2007, you could see the issues with the housing market. These banks were all insolvent, so you kind of have to look at that factor of it. And right now, I really don't see that. Yes, housing is extremely overpriced, but housing stocks, for example, are breaking out to new highs, like I showed in my video yesterday. So that's a sign that we're not in this kind of, really doom and gloom cycle here going forward. Now, like I said, we're overbought. The market should correct, but probably the fact that the market is acting so well going into the, flattening of the rate cycle, and then eventually into the cutting part or loosening part, is probably a good sign for the market.